Thank you, everyone, for joining us today. We appreciate your time and your interest. It's been quite a year with a lot of volatility, a lot of headlines. The team has done a great job in this environment. Through last night, the opportunity strategy was up 9.2% year to date versus the market up 6.9%. That's a little higher today. We're always vigilant about the risks and the opportunities in the market. So today we're going to talk about those. We'll talk about the current environment, the positioning, some stock ideas. We'll open it up to Q&A. For people who want the really abridged version of our views, we're still bullish. And I had the chance to catch up with Bill Miller earlier today, who's a great friend of mine, a great market master, a longtime colleague and investor in the business. And he can always put things much more succinctly than I can. So if you just want to hear, what he thought, he said, so I talked to him and he texted me this. It's a bull market and it's one that is broadening out. People are still way underinvested. The evidence is that the net effect of Trump's tariffs is at worst a one-time bump to inflation, but the PPI was 0 and it leads to CPI. So the wall of worry is intact and the worries are so far without substance. Very important. Again, the market predicts the economy and not the other way around. And so Bill and I talked about, what may make us change our view on being bullish, and we'll get into some of those details. So Christy, you can put up the slides. You can go to the first slide. I think most people on this call are familiar with us, Patient Capital. I started the firm in 2020 to launch institutionally a product that I had been managing since 2014 when I became the co-manager of Opportunity. When Bill decided to retire, Bill remains an investor, a friend, an investor in the firm and our funds. And I think when I think about Patient, I think there are a few things that are, some of the most important things, which is that, I was fortunate to join early in my career in a firm that had a long history and a philosophy and process that really dates back, over 4 decades. And we're continually refining and trying to improve it, but there's a lot of smart brains that went into developing the process that we practice. And I attribute a lot of our success to that process. I think at our core, we're long-term value investors. So we really are trying to value businesses, and then we compare, those fundamental intrinsic values to market expectations. And there's a lot that goes into both of those pieces, and we're looking for gaps between them, and then we try to let our winners run. And when we talk to our clients, I think what we hear the most in terms of what people like about us and find differentiated is that we are a value manager with the discipline around valuation. But at the same time, we've always tried to find, what are going to be the best values that can really truly compound for many years, decades. What are those companies? We have done a good job identifying those historically. Amazon, Alphabet, Google, Bitcoin, Coinbase, and we spend a lot of time looking for what those might be, but most companies do not fit into that category. So we have a lot of other companies in the portfolio that represent, short-term disconnects, opportunities, normalization. Christy, you can go on to the next slide. In terms of overall, again, when we step back from the market, a lot of volatility this year. The S&P was down 21% peak to trough on an intraday basis from February to April. It was one of the fastest, swiftest declines that we've ever experienced, which can only really be characterized as a crash. Sentiment was a little frothy going into that. And then obviously the tariff headlines, really took the wind, out of the market. But that since then we've had, an amazing recovery up, over 30% as, Trump backed away from the worst of those tariff threats. And so I think, when we step back, we've been in a secular bull market since the lows of 2009. And the market has compounded at, 16.8% a year, which is way above the longer term average of, the high 9s. That has been one of the longest, strongest bull markets in history. It started from a point of extreme pessimism. I remember that time period well. People thought the world was ending, extreme economic weakness, low valuations, but no one wanted to buy anything. PIMCO in the early part of the recovery talked about the new normal and how you wanted to be in bonds because we were going to have low economic growth. So people did not believe in the potential for the market. Opportunity, we have done well over the entirety of this period, up 18.1% a year, so 135 basis points better than the market per year. I think that that's especially good considering, how poor value has done during this period. So the S&P Value Index, gained 14.8% a year. And I think that's a fair bogey because that contains names like Microsoft and Apple and Amazon. So it does contain, those Mag 7 names. So we've, outperformed that by almost 337 or exactly 337 basis points per year. And again, I attribute that to our process of really being detailed around our work on intrinsic value, a variety of scenarios, and then looking for gaps in expectations. But I think the big question is, when does this end? And we don't think it's yet, and you want to be bullish until it does. You can go to the next slide. So we did ask ourselves, we had this big pullback in April. We published some stats on, how that looked to be a good buying opportunity to us if you looked at history. Then we had this very swift and strong recovery. So we looked, okay, so what does that imply? When you've had a bear market followed by, a very fast recovery, we did this from up 20% from the lows in the bear market. What does the market, continue to do after that? And the good news is it goes up. And on a 12-month basis, if we look now, this is a small sample size, so take it with a grain of salt, but it's up 100% of the time in the next 12 months. On average, it's up 28%. Same for 2 years, it's up 100% of the time, on average 19% a year. Then it mostly continues up. The one time it didn't was the tech bubble. And so that was a secular bull market peak. I think we'll get into more in terms of how this period compares to that one. But the good news is, the historical stats are favorable. Rich Ross at ISI has been the best technician, I think, in terms of covering, the market and remaining bullish, appropriately, getting defensive appropriately. And he believes that the S&P is going to 7,400, which would be another 18.5% gain from here. Again, we always show this slide, Sir John Templeton, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So we think a lot about where are we now. Certainly, we had significant pessimism at the lows in April. There was a lot of bearishness. Now we do see, pockets of euphoria, some optimism, but we still see significant skepticism, I think. And we'll go into some of those stats. So this is really interesting. We published a piece on this, but it could be one of the most hated rallies in history. You can see here Consumer Sentiment Index. And as recently as May, it's come up a little bit in June, but in May we were at historical trough levels, on par with June of 2022, 2011, even worse than 2008, which is pretty astounding. And the good news is, historically, after this point, after troughs, the market's up again 24% a year. So the consumer's been quite bearish, and I think that manifests in some areas of the market more than others. But again, overall pessimism is the friend of an investor. We looked at past secular bull market peaks just to see what we could learn from those periods. And again, I think the good news is we're not yet at those levels. Sentiment, consumer sentiment here, it shows versus the tech bubble and the Nifty 50 peak, is much more constrained. You can look at put call ratios, total put volume, trading composite index. Now, some of these, are getting more optimistic as the market increases, but we're not at extreme levels. And there's a lot of good reasons to think we may end at similar levels. Another, difference from historical secular bull market peaks is just the overall economy. So if you look at cyclical components of GDP, leading indicators, money supply, they were overheated, at previous peaks, and the Fed was tightening. Now, while valuations are higher than long-term averages and near the high end of what we've seen historically, they're not as crazy as those bubbles. And so you can see here on the bottom, the top 25 stocks during each period. Currently they're 46.3 times earnings, which is high, but it's still well below the tech bubble at 71 times, well below Nifty 50, which was at 55 times. Again, for us, we tend to try to avoid those areas that we find the most frothy, and we think all of our names in the portfolio are still undervalued. I won't spend a lot of time. I showed this last time. The point here is just this looks at economists' forecasts of interest rates. And again, just every 6 months, they make a forecast. If it's, they actually give the number, but we give them credit for being right if they're just directionally correct. So if they say a higher number and it's higher, we say that's right. So here they have a 42% success rate. Forecasting the macro is impossible. I mean, that's the basic point. These are economists. The market is the most accurate indicator. So we give a lot of credence to what the market is telling us, to Bill's point earlier on. And the market has broadened out lately. And some of the higher perceived risk names in the market, like companies with higher leverage, smaller cap companies, more cyclical companies, have really started performing much better just in the past few weeks to past month. And so that's a good sign, I think, about the economy overall. When I step back and think about, some of the things that I think are most important, we do try to understand the current environment. That's different than predicting what's going to happen in the future, but the economy has been far more resilient than people have expected. So basically, since the Fed started increasing rates in 2022, people have expected a recession, and the economy has continued to grow. And so that resiliency has been just far greater than what people have anticipated. I think that's important. On the next slide, the other thing I think is important is that the disinflationary forces in the economy, have mostly continuously been underestimated. So after the financial crisis, inflation only hit the Fed's target in 2 quarters. And it was below the entirety of the time. And that there was big concerns about how much inflation we'd see given the growth in money supply, but that didn't happen. So there was a lot of, disinflation, deflationary forces. Then we had the COVID surge in inflation, which was a combination of supply shocks and, very large money growth. And then most people didn't think we would get inflation back into a normal range without a recession, but we have. And so the Fed's target's 2%, which is mostly just a made-up number that comes from nowhere as far as I can tell. The market tells you 2 to 3% is an optimal range. The market valuation, when you're in that range, is the same. So below that and above that, you start to have problems. And we've gotten there, and we're basically there. And if you look, excluding shelter, we're below 2. That's what this dark line shows. And shelter is very lagged, and it's coming down. And there were a lot of headlines yesterday after those inflation numbers on how we're starting to see the impact of tariffs. And I get that's true if you look at goods inflation, because it's ticking up a little. But services inflation and shelter inflation were less than expected. So overall, actually, inflation was lower than expected. And so again, I just think the inflationary environment is benign, and that should allow the Fed to cut rates later than this year, which is a powerful, stimulus for markets. You can go on to the next page. And there's a number of reasons that I think are important to just go through quickly in terms of why, higher valuations are justified in the market. And one is that the market consists of much better companies than it has historically consisted of. And so you can see here the free cash flow margins of the S&P 500, you can see it's basically a straight line up from 1980. They're double what they were in the 90s. And so we just have these cash machines in the market. Technology is a big piece of this story, but that's a powerful financial fundamental force, which justifies higher valuations. At the same time, we have talked about this a lot. We think we're in a technological revolution. There's been a ton of skepticism about this the entire time, which is great. Again, we just look to the people who are experts in this space to help us understand. And I think every single one of them believes this is, one of the biggest or the biggest technological revolution in history. Here's a quote from Rich Fairbanks, who's the CEO of Capital One, which he calls the original, fintech company. It said, the digital revolution has given birth to the AI revolution, which may be the greatest transformation in history. And he compares that to the agricultural revolution, the industrial revolution, the digital revolution, I think harnessing fire. So those are pretty, tough compares. And adoption is increasing. People have questioned the ROI of the investments, but now despite clearly having some verticals like software development where it's quite clear there's a strong ROI. But now you're starting to see it more broadly in some productivity numbers. Rick Reeder at BlackRock was out yesterday with a piece on the productivity revolution. And he showed some Goldman numbers in that piece on, how productivity growth in the US is far and above other countries. So again, I think every company meeting that I'm in, AI comes up and the impact and the transformation potential for businesses. And so I think this is a big deal. Again, I think we're still early in this. Another, important tailwind for the markets is just, again, these companies are generating significant amounts of free cash flow and they're returning a lot of it to shareholders. So this looks at the return of capital as a share of the equity base, and that includes dividends and repurchases. And you can see recently it's been about 15%, of the base rate, which that's very powerful dynamics. Share repurchases have outpaced issuances 4-1. And so again, corporations are net shrinking their stock of capital outstanding, which is another powerful force for markets and valuations. And then Fed easing cycles. So, historically they've, been a powerful tailwind for markets, up between 10 and 20% a year after Fed rate cuts start. You can see many of these charts in the 1 year are far in excess of that. The Fed started cutting rates last October. The market's up about 11 to 12% since then. The Fed's on pause, but it's expected to cut rates later this year. I think when I last checked, it was expected in October, but that moves around, every day. But they're still slightly restrictive. The president's trying to pressure them to do it sooner. If he really wants them to do that, he should stop with the tariff threats, because that's what they need, some confidence on. But I think, as long as inflation remains benign, or if employment deteriorates, but the employment market's been quite stable and robust, Fed rate cuts should be coming, and there should be 2 by early next year. And then there does remain, a number of risks, as there always does in markets. So one of Bill's best pieces talked about the whatabouts. And he said, there's always whatabouts in markets. What about this? What about that? What about? He's like, when you really need to become concerned is when the whatabouts stop. So there's still lots of whatabouts. Tariffs, is a big one, an important one. You can see here, the blue bar on the far right is, assuming that was the tariff level that would have been in place June 30th. The orange bar is the threat of tariffs at April 8th. So right now we're somewhere in between that if Trump goes through with his most recent round of threats. It's a huge increase from historical levels, which is why the market freaked out in April. But I think the market is not freaking out on these most recent threats. And I think there's a couple of reasons for that. One is the, big, beautiful bill mostly completely offsets tariffs. If you look at the stimulative impact of that bill. And it's a net benefit for all for consumers of every income cohort except the lowest end because of the cuts to Medicaid and SNAP. So it's a drag for them. I think the market also seems to believe that Trump's threats will not play out, into the final numbers. I think that Trump loves to make a deal, and he's going to make the best deal he can. But I think he showed again today that, with the news on Powell and firing Powell, and then the market started to sell off, and then, he came out and said he's not going to do that. So I think he does react to the market. He does love tariffs, but I think, so he wants to get as much tariffs as the market can handle, probably. Other sources of risk are immigration. Again, that's probably a bigger inflationary source to both inflation and growth, because obviously the economic potential, is based on population times productivity. So we have a lot of benefits on the productivity side, that should be coming through with AI. But immigration was a big source and the primary source of population growth. So, where that shakes out is, we're monitoring closely. It's another source of risk. Geopolitics, deficits, we get lots of questions on those. I think monitoring those, an increase in interest rates is a risk, although it appears certainly that the administration is very sensitive to that risk. And, the market is very comfortable with where we are now. These tariffs are bringing in a lot of money for the country. I think in June, it was $27 billion that was brought in from tariffs. So that's, annualizing $300 billion a year, so significant amount of offset to, some of the deficits. In terms of the portfolio and the strategy, and what we're doing in this market, I think it's always a balancing act between, letting our winners run, which is a very important thing to do in markets, particularly when you have companies that are secularly advantaged and have long-term potential. And in this market, those companies, are in favor, and so they have done well, and their valuations are up more. And then redeploying capital to laggards. And, we're contrarian value investors, so we're always looking for names that have some temporary problem that we don't think, the market is appropriately reflecting the long-term fundamentals of the business. So you can see right now, over the past year, about 3/4 of the portfolio has outperformed the market, and 35% were a little levered long, so that's why they don't equal up to 100%, has underperformed. And we have been selling some winners and redeploying to losers, and we think there are some really attractive, opportunities that are in the market right now. We have a diversified portfolio. We have a good number of, most of our exposure is in what we call classic values. So names that everyone would recognize as value stocks. They look cheap on the multiples. Those are names like Citigroup and Norwegian Cruise Lines and CVS. We also have what we call attractively valued compounders. These are companies that we think can compound, capital over the long term, and they are attractively valued, or else we wouldn't own them. But they might not look cheap on the metrics necessarily. So names like Amazon, and Alphabet, which actually does look cheap on the metrics, Royalty Pharma, which also looks cheap on the metrics. Our favorite is when companies like Royalty Pharma or Alphabet, we think, could fit into two buckets. And then we've always looked for those earlier stage companies that we think, could be the best long-term, gainers, and that maybe are misunderstood because they're just earlier in their life cycle. So companies like Coinbase or SoFi, Tempest AI is a new company in the portfolio. The only other thing I would point out, a couple of things. One, you can see that the portfolio trades at a significant discount to the market. So, as of quarter end, the S&P was at 22.5 times. It's a little higher at 23.6 or 7 times now. The portfolio is at 13.9 times, significant discount, with growth that's slightly less, expected growth of 9.1% versus 10.5% for the market. And that's primarily, because a number of companies like our airlines or United Healthcare, are having some temporary headwinds. We've been adding to some of those companies. So again, as I think about it, we still think the secular bull market, is continuing. There's still significant upside. When the secular bull market ends, I think, having value exposure is important. After previous peaks, value vastly outperformed. So, you can go on, Chrissy. Again, there are pockets of, where we think things are more optimistic. Euphoric quality is one that we've talked about. Everyone loves quality. I love quality, but it's what you pay versus what you get. So you can see that we're not quite at the levels of the, tech bubble peak again, not quite there, but directionally we're closer to that level. And then there are pockets of, where we think expectations are still quite depressed. You can go on the next slide. And so one of those examples is small cap. And you can see here, small value actually trades below long-term historical multiples. And so it's actually at a discount, even in this market, which is quite astounding. We now have about 29% of the portfolio in small cap, and we measure that as companies that are less than 10 billion. Another segment that has done poorly and trades quite cheap relative to its long-term history is healthcare. So there's been a number of macro concerns about, healthcare businesses. So we've found a number of interesting opportunities in that area. I'll talk to that a little bit more shortly. But that part of the portfolio is like 21%. So between those two buckets of laggards, it's almost half the portfolio. If you throw in energy, another laggard bucket, it is more than half the portfolio. So again, there's a lot of the portfolio that we think is still, quite undervalued. And our job on a day-to-day basis is to find those areas where we think there's still mispricings. A couple of stock names we'll go through, and then we'll get into, we'll talk a little bit about what's driven the portfolio, and then we'll get into Q&A. So Norwegian, this has been one of my favorites. I talked about it a lot in the sell-off. It went from 29, I think it hit 14 at the lows, so it was just crushed, which was way out of proportion with, actually any impact that they'd seen on their results. And now it's regaining its ground. It's back to, $22, $23 a share. I think it actually closed above 23 today. The other big cruise lines like Viking and Royal and Carnival are actually at 52-week highs. So I would expect this one to follow. I think, one, there's some very attractive things about cruise overall, which is that it's only 2% of spend on vacation. So it's a small piece of overall travel spend. And it's, had secular growth for, decades, which we expect to continue. You can see now, Disney and Four Seasons are getting into cruise. Actually, I think that's going to raise awareness and help the industry. It's a great value proposition for customers. It trades at well over a 20 the price of a cruise vacation is 20 to 30% cheaper than a land-based vacation. And then on Norwegian specifically, they are, one, they have a new management team. And so there's a cultural transformation here. And I went to see the company and met with everyone on their management team, I guess last month. And, their head of operations, Patrick Dahlgren, came from Royal, which is the darling in the industry. And it was interesting to hear him talk about how those two companies have swapped. And he sees now a much longer term focus at Norwegian, much greater, growth potential and potential to improve margins over the long term, improve returns on capital, and how they're very, very early in this. So we think it has great growth potential. We think it's going to grow, earnings and cash flow at, high teens over the next 5 to 10 years. And it's only 11 times earnings, 11 times this, I think 7 or 8 times next. So this is a company that, I think is, and from everything we've heard, there was some choppiness in vacation spend in April around the tariff headlines, but that's mostly totally recovered. especially for cruises, mostly tap into, the high-end consumer, and they're doing quite well. So some of the low end is still, challenged. You see that at the airlines, but that's less applicable to the cruise lines. So United Healthcare is a name that has been crushed. We've are very excited about this. We've aggressively built a position here. We followed this company for a very long time, and continuously did our work on what we thought the company was worth, but didn't take action until the most recent. There's headlines every day, so it might not be the most recent, but when they announced that they were pulling guidance and that Steve Helmsley was coming back as CEO, we have a return of the king rule that's historically quite effective when you have a former CEO who did a great job. So I think basically there's a lot of pessimism priced into the stock. This was a darling. It beat earnings for 60 consecutive quarters. People were piled in because they could rely on it to beat. First of all, any company that beats for 60 consecutive quarters is, probably doing some stuff to do that. That's not how results naturally flow. But I think the biggest challenge has been, a classic underwriting cycle in the Medicare Advantage business. And so, those earnings are, depressed right now, but there's no reason to believe they can't recover, over the next 3 to 5 years. And so when we look at the earnings power of this business, the stock, today is below 300. It actually is down from the end of the quarter. It's like 292. We think they can earn $40 to $44 a share, in 2028, 2029. And so if it does that and it trades at, historical multiples of about 16 times, which we think it should, given its growth potential and its return on capital, then it would imply it will trade back to $600 or $700 a share over that time period. And there might be more headlines in the short term that weigh on the stock, but we think the risk reward here is extremely attractive. QXO is now the largest name in the portfolio, so I thought I'd mention it. We did a PIPE transaction with this company last July. And so again, I think one of the advantages we have is the flexibility in the fund. We have the flexibility to go anywhere in the market cap spectrum, depending on where the best values are, anywhere. We have flexibility to invest in different types of securities. And so Brad Jacobs, who many of you might have heard of, he is a serial entrepreneur with a great track record. He founded United Rentals, United Waste, XPO Logistics. And again, he's delivered excellent results historically. When he bought QXO, we started paying attention to what he was doing there. He started talking about how he wanted to roll up the building products industry. Then he did a PIPE with some other investors. We reached out. He wanted patient capital. We ended up investing at just over $9 a share. The stock today is at 21, so it's done great over the past year. Initially it was just a pile of cash. They completed, last quarter, their first acquisition of Beacon Roofing, which is a scaled business. It's 80% repair, remodel roofs. So again, that's a pretty non-discretionary, stable sort of purchase. Their plan is to roll up the industry, and we think it has significant potential over the next decade. So they'll do more acquisitions, but they're very price disciplined. There's 2 other companies they've attempted to acquire unsuccessfully. So, they were outbid by Home Depot for GMS. So they're quite disciplined. So again, we think, that company has the potential to compound at close to 20% a year, over the next decade. In terms of, what's helped and what's hurt us, you can see here our contributors and detractors for the quarter and for the year-to-date period. I think one thing that's interesting on our top 10 contributors is I think 7 out of these 10 companies, got hit over the past year pretty hard, and we added aggressively too. So that was certainly true for Coinbase. That hit $140 a share. NVIDIA, I think in April got to $80 a share. Dave & Buster's got down to 15. They all had pullbacks, but SoFi a year ago was 6, it's 21 now. We added the Fidelity Bitcoin fund. And then Royalty Pharma was trading in the mid 20s, and today it's 35, late last year. So again, one thing we try to do, there's a lot of single stock volatility in the market. We try to monetize that volatility. So, we're adding to things aggressively when we have conviction into weakness, and then we're paring them back when the markets get overly enthusiastic. On our, detractors, we have a couple energy names in there. We exited New Fortress. They disappointed fundamentals pretty significantly when they reported the quarter, and they have a bad balance sheet. So again, when we think about risk, we don't let the stock price tell us what the risk is, but we do let the fundamentals of the business. And so and we sometimes expect weakness and expect cyclicality, but if it's beyond what we were expecting, that's a source of risk that we think about pretty carefully. Cosmos Energy, again, all energy stocks have been hit pretty hard in this environment. We think that one has significant upside potential. They're doing a few things to fix the balance sheet. They have maturities, so the market's got nervous about those maturities in a environment where oil prices are perceived to, have downside potential. Some China stocks, Biogen, Mattel, S4, and Crocs. So with that, I think we can go on to questions.
Great. Thank you, Sam. We've actually already started to get some questions pouring in live. So I was going to take one from there to start us off, because I think it's probably just a good grounding for us. They want to better understand our stewardship ethos. And can you talk about how the team is aligned with shareholders by being invested in the fund? I know you've hit on that a couple of times, that we're fully invested alongside our partners, but just kind of highlighting that for everyone.
Yeah, no, this is a great question, and something I'm passionate about. Again, my dream and vision is to build one of the most investor-friendly asset management companies. So what does that mean? It means we make all our decisions based on what's best for our clients and our investors. And so that means we eat our own cooking. We're investing in our products. I think the majority of my liquid net worth is in our funds. I don't think most portfolio managers can say that. All our team is significantly invested in our funds. I've started some long-term incentive comp programs for our investment team that, again, we grant on an annual basis, and they vest on a 5-year basis only if we outperform the market. And so they can make a lot of money only if we outperform the market. And, we've grown those. I launched the first one, I guess, in 2023, and we did the second program last year. And so those will continue to grow over time. And then they have, the rest of the team has investments outside that as well. But we think a lot about, how can we improve the value proposition for our investors? And so, any costs that our investors bear, so whether it's taxes, we're very sensitive to that. We manage our, tax situation very closely and carefully. Administrative costs, again, we're very active about managing all of those things.
Thanks, Sam. Kind of going on that and touching on the market to begin with. You hit on this, in your slides, but I guess we've never really seen such high levels of pessimism at the same time we had such elevated valuations. And so I guess as you think about the opportunities in the market, I mean, one thing that we talk about constantly is that there's divergence in valuation. And so not everything is trading at the top of the page. So can you talk about how we go about investing in a market like this?
Yeah, well, one, I would just comment that it is unique, a very unique thing to have some sentiment readings that are so bad at the same time that, generally things are pretty good. It's certainly in the markets, maybe not in April, they weren't good, but, in the post-pandemic period, I think that consumer sentiment the entire time was below average, the long-term average. So you have inflation, and you have, interest rates, and you have geopolitics in a very divided country, and social media. And so I think there's a lot that just weighs on people. Certainly inflation, in the consumer's mind has been, has weighed heavily. So one, pessimism is a great thing. Like, it's good. I think if we had all the same conditions with extreme optimism, we would be less optimistic overall. And then I think you can see, places where the pessimism manifests, more acutely in the markets. So whether it's small cap or whether it's healthcare, or whether, it's cyclical companies, and at certain points over the past few years, it's been extreme. And then at other points, it's been less extreme. But I think we're always looking at, where are there areas of weakness in the market? And, those are great opportunities to find maybe disconnects between long-term, fundamentals. And at the same time, I think if you're in a technological revolution led by AI, technology has led this market. And, those AI leaders have led this market. And I would expect that to continue until the end of the secular bull market. And so we have those names too. And I think, fortunately, we're not yet at this point where you have to make the tough decision about, okay, these things are just too expensive to own. Because, I think we have some questions on some of these companies, but, Cisco, I think, peaked at 140 times earnings in the tech bubble. NVIDIA is at like 37 times earnings as a comparable leader, totally dominant in its space. And it is unlike Cisco, they were build it and they will come with, 20% capacity utilization in that period. Now, NVIDIA has been consistently in shortages. So it's just a very different, environment. But again, what our process is, again, we do a lot of work on what's the intrinsic value of a business, and that's based on a variety of scenarios. We look at different scenarios and what's the risk reward, and when would things work out well, what are the risks to that, and then what are the market expectations, and where are people, really excited versus where are they, still really nervous. We tend to be more excited when in areas other people are nervous.
Oh, that's really helpful. I guess when we think about the strategy in general, as you've highlighted a couple of times, returns have been good. But what do you think about the potential upside from here, I guess, and how do you think about the buy and sell discipline after such a strong move?
Yeah, well, I think one, we track the upside and we update those numbers weekly. And as of this week, it was still 70% upside to what we think, the companies are worth. There are some companies that are at or, even a little above our assessment of value. Those are candidates to pare back. But again, our ideal is to own a company from undervaluation to overvaluation. And I think we exhibit the same discipline and the same approach in all markets, which is, where do we see the most attractive risk reward? And our objective is to outperform and earn, strong returns over the long term. And so, so on the buy side, it's much easier. Investors exhibit much more skill on the buy side to, find opportunities. Now, we still make mistakes. Mistakes are common in this business, but you do your work on, what is the company worth? What's the market getting wrong? What's the opportunity? And then you invest. I think it's much more difficult on the sell side because investors tend to sell their winners too soon. And I have done that, way more than I want to, admit. We sold Apple, we sold Netflix. I remember meeting with Reed Hastings, with Bill, and we were on our way to the meeting. And I said, Bill, we got to figure out, this Netflix looks expensive, and we got to figure out what's going to drive it up from here. And we get there and Bill says, Samantha says we should sell Netflix. So can you tell her, Reed, why, that is wrong? And it was wrong, but we still, we didn't sell it right then, but we did sell it. And so as a value investor, especially, you tend to sell your winners too soon. Now, so we try to distinguish on that between our long-term secular, what companies have real long-term secular potential here, and, versus some short-term mispricing, and we treat those a little differently. But at the end of the day, on the sell side, we sell names when, one, the risk return is just not adequate. the risk goes up because prices are up a lot more, and optimism is high and the return potential comes down, the higher prices go. Or we're wrong and we make a mistake, and that happens all the time to us. So we try to identify those situations as quickly as possible and get out of them. That's the objective there. Or we find a better investment opportunity. So if we just find a name that we're more excited about, we think has a better risk return, we will have to sell some names to buy those. But that's the process. And I think the upside is less than it was in April when we had 156% upside in the fund, but that's extreme. That's not normal. Buy when we have these sell-offs, that's the best rule, but 70% is still significant.
Yeah, we always talk about constantly reevaluating, comparing to what's out there versus what we own. I think this will actually be a great segue into a question we're getting, which is, what are some of the names that get you most excited over the next 2 years?
Yeah, 2 years. These things are all so sensitive to your time horizon. So, I gave a number of names that I'm very excited about, and I think I would be excited about all of them over 2 years. I think over 2 years, my best guess, which is maybe as bad as those economists, but that this secular bull market will continue for the next couple of years, and that's led by technology and AI. And so leaders in that market are names like NVIDIA and Amazon, and Alphabet's lagged lately, but I think it's extremely attractive, and they have great assets, and I expect them to execute well. So those would be contenders over the next couple of years if we continue in this sort of environment. But everyone owns those, so I like them a lot, but I get more excited about the unloved, hated, sort of left for dead companies. I think IAC is a company that I think is super interesting. It's a small cap that has a $3.3 billion market cap. Barry Diller, is the head of that company. He just stepped back into the CEO seat after Joey Levin left, and I think he wants to get the stock working. And the stock's trading at about $40 a share, and we think the assets they own are worth over $80 a share. And their stake in MGM, which is public, and so we know the value of that, and their corporate cash alone are worth over $40 a share. So everything else they own, Care.com, Dotdash Meredith, which is an advertising business that's really well positioned and doing really well. Turo, they have a stake in, and a search business. All of those businesses you're getting for free. So I think that's super attractive and interesting, and I think Barry will figure out what he needs to do to make the stock actually reflect that value.
And just a quick question, we don't have to go too far off on this, but this kind of, ties into that. Someone asked that if we are in the 1990s, what year are we in?
Yeah. Well, that's a good question. And I've been comparing it to 1998. And so again, a huge grain of salt here because, these comparisons, they're generalistic. But it was interesting in 1998, you had the Asian financial crisis and the market sold off significantly. This year you had the tariff tantrum and the market sold off significantly. And so again, after that you had another year and a half of gains in the market, but they were huge gains. So I actually hope we have more moderate gains for a more extended period of time. And I think the good news is, again, on the AI front, we're not seeing signs of economic excess. We're not seeing that in the economy or on AI yet. And so you did have that in the late 90s, and that led to a peak. So again, my best guess would be that we ended at more extreme valuations than we did then. Again, that could be derailed by a number of things, but so again, I would say 98, but it could last longer.
And we've gotten a couple, specific questions on names that we've held. Some we've held for a very long time. Some are newer to the portfolio. So I'm going to try to go through some of those and try to hit on everyone's favorite company. The first question we've gotten about is Amazon. Just can you, highlight why we still think it's attractive today?
Yes, Amazon. we still find it extremely attractive. I think it's our second largest holding, I believe, still a top holding. Again, I think Amazon, the thing that makes it most attractive, well, one, the culture and what they were built to do, which is innovate at scale. And so they have done that. And so I think it has some of the longest duration growth potential of any company. And if you think about it, what Amazon is, an e-commerce platform, leader in that, AWS, cloud hyperscaler, leader in that, ad business, which is just built up and now it's a leader in that, logistics business, which is it's now a leader in that. And then they're still focused on building all these other new businesses that are not currently reflected at all in the value of the company. So AI, they're very focused on, they will be a leader there. That's, sort of relates to the AWS. Healthcare, huge market, and they're very early. And, it's hard, you can't quantify yet and even understand the details about how big that business could be. Or Kuiper, which is like Starlink, which they're very early, but can be, a big business for the company. And so, grocery, which they, have a little business in, but they're still focused on figuring out how to make it much bigger. And so, again, I just think, not many companies, virtually none, have been able to build that many significant businesses. And it trades at 36 times earnings, PE, which is high, but not extreme for this kind of company. The Nifty 50 peaked in the low 40s, and then they did poorly for a while, but over the long term, that was a fairly priced group of businesses. So they were fairly priced in the low 40s. And they weren't as good businesses as Amazon was. And I don't think none of them innovated at scale. And Amazon's 15 times enterprise value to EBITDA. Costco's, 53 times earnings and 33 times, EBITDA. And so again, for what you're getting, every time Amazon goes through an investment cycle, which they are going through, with AI, the market gets concerned. Now, it's still near the high, so it's not that concerned. But in terms of the valuation, I think these concerns have kept the valuations more contained. And I think Andy Jassy is great. They talked about having fewer employees. He's talked about having fewer employees. So they're going to get, a lot more cost savings from AI, which we haven't seen come out in the numbers. So I just think Amazon is just a long-term hold, certainly at these valuations.
And it's definitely been a long-term hold for us for a long time. A couple other names that we can probably hit on quickly. United Airlines, that's a name that we've held on and off for a long time as well. Can you just hit on what you think about it from here, since it had a pretty strong rebound after the sell-off earlier this year?
Yeah, so we still own United and Delta. I think that these two airlines in particular have evolved their business models. And, Delta earns almost 60% of its earnings from premium non-main cabin areas. That includes, their loyalty program with their agreement with American Express, the premium cabin, the MRO maintenance organization. And those earning streams are just much more stable. And through this environment where that main cabin part of the business has gotten hit, the other pieces have kept growing. And so United is following Delta's lead in the premiumization of the business. And now these premium airlines have advantages, which is very different from historically relative to the low-cost carriers because of the inflation and pilot wages and, constrained, planes. And so, we're seeing a lot of stress in other areas of the industry. Capacity is coming out. But I think Delta still trades at a 10%, free cash flow yield. Actually like United better in here. Delta's a mid-teens return on capital business. I think United can can continue to follow in, Delta's direction. It's trading at $86, $87 a share. They gave guidance that said this year, if we didn't have a recession, they'd earn $11.50 to $13.50 a share. Consensus is just below 10. So consensus doesn't believe it. I don't see why, they don't believe it, because again, we've definitely seen stabilization. So it's trading at 7.5 times the low end. of that earnings. A while ago, United gave guidance that over the long term, it could earn $20 a share. And they're, doing some things in terms of upgauging some of their planes, and that all the other airlines have already done, which is a source of earnings growth for the company. So I just think it's too cheap. I think these businesses are better businesses than they've been historically. They still have volatile earnings, but so do banks, and so do a number of other sort of companies that that have historically traded at 10 times, and in this economy are trading at 13 to 15 times.
Yeah, I think even as a customer, I can tell that United has definitely tried to go after the experience that Delta has provided for a long time. So
yeah, and Scott Kirby, the CEO, he was just ranked on, I think it was the Wall Street Journal's list as one of the, or maybe Barron's, as one of the top CEOs. And so he's an animal, and he's done a great job there.
yes, very impressive. So Tempest AI is a new name. Could we just kind of hit on our thinking there?
Yeah, so that's a small position, but it's a name that we think is super interesting in terms of the business that they've built and the potential over the long term. So they've got agreements with all sorts of hospitals, on data sharing, and they have an AI business and they have agreements with a number of pharmaceutical companies and drug companies. So they use their models and their AI, primarily now in the cancer business to help, tailor treatments for people and monitor for residual disease. But they're expanding out, to many other areas in terms of helping pharmaceutical companies. They spend gobs of money to run these clinical trials. A large percentage of them fail. And so now with AI, I think healthcare, is one of the areas of greatest opportunity, although it's just given all the regulations in the industry. Eric Lefkofsky, who we knew, he ran Groupon, he runs this company and founded this company, said things that take 2 years in other industries take 15. But they've built up these relationships, and they have a lot of this data. And so I think that's a huge asset. And so, they have a number of pharma deals in terms of, building models and sharing that data. So again, we think that that's a big opportunity, and we're very, very early.
Yeah, there's a lot of exciting stuff happening in healthcare. I think one name that we've owned for a while that we've gotten a lot of questions on, and we talk about all the time, is Pregen. They have their BLA coming up at the end of, or PDUFA date coming up at the end of August. How are you thinking about that one, the risk, the ability to self-fund? Like, what are your overall thoughts there?
Yeah, so Pregen we have a long history with. It was formerly in Trexon. We did exit it. We try to be disciplined about areas where we've been wrong for a very long time, exiting it, but then we can always come back. And so we did come back into this one. Helen Sabsavari, the CEO, I think is just excellent. She has done a great job since she took over, 2019, 2020, moving the business forward and advancing clinical trials and really focusing on, it became healthcare focused, and they focused on orphan drug indications. So we did a capital raise, with the company last December. Bill Miller, patient, RJ Kirk, who's, the founder and on the board, led the capital raise, which will get them through this trial date, which they'll get, or, they get the results, hopefully approval next month, which we have a high degree of confidence that will happen. The indication, respiratory papillomatosis, doesn't have any treatments. These patients have, a number of surgeries a year. Christy can talk more about this. She recently attended an event with the company and met a lot of these patients. And the people who treat these diseases are really excited to have an alternative treatment. You can get, basically a shot with Pregen, and they have a great success rate. And so I think over, half of the patients, don't need any more surgeries for, I can't remember if they, the final data that's come out is like 18 months or 2 years, after initial treatment. So that's transformative. These surgeries ruin these people's lives. And so we expect approval. I don't think there's much risk around approval. There's more risk around commercialization, which they're going to head into commercialization starting in September. Most companies, have some bumps in the road along the path to commercialization. Precigen thinks they can make it to cash flow break even, on this indication alone, and then they can, increase their investment in a bunch of other, assets they have in the pipeline, which we're excited about. They might need another capital raise, to get them there. That wouldn't surprise me. If they don't get approval, they would certainly need another capital raise, and the balance sheet would be, quite challenged. I just don't expect that to happen. Christy, do you have any?
Yeah, I would just quickly say I went to the patient awareness day, and it was, you read about all the surgeries and the terrible disease and no treatment, but it's different to hear from patients talking about how, well, first off, their voice is so hard to hear. It's very light. And they talk about basically being forced to all be introverts because no one can hear them speak in any sort of social capacity, and even at work. And then what you find out is not only do they have to prepare weeks for the surgery, once they have surgery, they can't speak for an entire month. And so it's really life-changing, the fact that they can potentially avoid having to have any surgeries. And so the safety profile is extremely strong. And so like Sam said, I would be highly surprised if it doesn't get approval. There's no safety concerns. They have really strong efficacy. In terms of the launch, there's always potential hiccups there, but they have put together really strong partners. They've already been in the field talking to doctors, educating them. And so, we're optimistic about that getting to market and really meeting a really strong unmet need. We can't get away from talking about names without covering, cryptocurrency, Bitcoin, Fidelity, Bitcoin Trust. Can you just kind of hit on, and Coinbase, of course. So can you hit on kind of, the overall broad route on cryptocurrency, why we own, particularly Bitcoin focused exposure as well as Coinbase?
Yes. So on Bitcoin, my view has been that Bitcoin is like digital gold. And it took me a while to get to that view, but I've had it, basically since 2020. There's $22 trillion of gold above ground, and Bitcoin's market cap is 2.3 trillion. And I think this is starting to catch on somewhat. I saw a recent presentation from Coatue, which they're excellent investors. And, they laid out what they saw as the best opportunities in this AI, technological revolution. Bitcoin was on the list. They thought, the market cap could go to 5 trillion over the next few years. So if that's the case, Bitcoin will go to 250,000 from, 119 or wherever it is today, and it'll compound at 20%. I think over the long term, the potential is much higher. It's just a very unique asset. I think Bill was very early here, and his view is never in the history of the world have you had an asset where higher price doesn't create more supply, because the number of Bitcoins is capped at 21 million. So, even if every millionaire wanted one, they can't have one, or the price has to be, much higher. So again, that's a unique sort of asset. We still think there's significant upside potential. Coinbase, we think of as the platform for crypto and blockchain more broadly. And there's a lot of potential, around what this technology can do. But, there's also obviously a lot of risks. And if you lose your key, you can't lose, all your money, and you need some safe way to, switch from fiat currency to, crypto. Stable coins, obviously, there's been recent legislation. They're trying to get, the Genius Act passed, which I think that one will get passed. The other ones, we'll see if they get passed. But, that's a big potential market. And there's a lot of benefits from the tokenization of assets in terms of having certain information on a chain. You can transact at lower cost more quickly. And I think what we've seen as the internet has developed is that there are these platform aggregator companies. And, if Coinbase is successful in developing that position, it has huge potential upside, especially as this market continues to grow over the long term. So, that's the basis for our, investment in those companies.
And someone wanted to know if we still like oil and gas. I think in our last slide, we showed that a lot of those names might have ended up on the top detractors year to date. We're still adding new names there. I think one of the new names that we highlighted was Noble Energy that we added in the quarter. So can you just kind of hit on how we're thinking about that sector and the names that we own?
Yeah, I mean, I think there's a lot of interesting names in that space. In energy, the best advice I've heard from a quant was like, nobody knows nothing. So when people are really excited about the prospects for prices, and that's usually not a time to get excited, and the reverse is true. So our process is, we try to think about what normalized prices are, which we mostly look at the marginal cost of production, and then, the long-term futures curve and what those two things imply. And then if we can find opportunities that we think are, attractive risk rewards, we'll invest. So I think there are a number of names within that space that are attractive right here, with these prices. I think, the risk is that prices go down more and things get worse before they get better. So that you just have to think about, tactically how you build positions. But we own, a number of names. I mentioned Cosmos Energy, which we think has, huge upside potential. They have a number of assets in the Gulf of America, I guess it is, and off of Africa. They have, clean assets that are low cost, and, they've had some production delays, which has depressed the stock price. But now they're, bringing on production, and, if they do that successfully, they'll generate huge free cash flow. Should be starting now, and into the next year it will grow. And so we think that stock is extremely mispriced if they execute. We own Seadrill in the offshore drilling space. We added Noble, which has over a 7% dividend yield that we think is sustainable. And what's interesting about offshore is, shale growth is going to be more limited. And, those companies have done a great job with well productivity, but it's going to be harder to grow, the amount of oil from the shale resource. So we're going to have to look for alternative sources of oil and gas, and offshore is, probably the most promising prospect. And the offshore drillers, went through a huge cycle of overbuilding drill rigs, in the last cycle, so the late 2000s, early 2010s. And then there's, then we went through the reverse, and there was a bunch of bankruptcies, and they're still taking a bunch of supply out of the industry. So you have this interesting thing where you have, supply shrinking, and you're about to need, and again, I don't know if it'll happen next year, it might take a couple of years, there's going to be a higher call on those assets. And so when you have that sort of situation, you can get pricing that just goes bananas. And again, these companies have much better balance sheets. I think they can withstand, a challenging period or some delays to when that ultimately manifests. But I think they're, and you get paid with Noble 7% a year to wait. I think it's a very interesting opportunity.
It's an attractive setup. Well, Sam, that answers all the questions that we were able to fit in today. Any questions that we were not able to explicitly answer, we will be in touch and make sure that we close the loop there. I'll hand it back to you for final comments.
Great. Thank you all so much. I want to thank the team. They put a lot of work into this and into everything we do. So thank you so much. I want to thank everyone for joining. I think we have the best clients in the business. A lot of our clients have been with us a very long time. Bill always says, people should love volatility in markets because they can make more money. And I said, yeah, Bill, but that's not how people work. But I think our clients do get that, and they've, done that quite well. We had a number of people add in April. We always get thoughtful questions. I feel very fortunate, to have the team and the clients that we have. So we appreciate everyone's time, and thank you for joining us.